All right, everybody. Thank you so much for joining us today at the Planet MicroCap Showcase Vegas 2023. I'd like to introduce our next presentation on the top tier track, moderated and hosted by Maj Soueidan from geoinvesting.com. His next guest here is Ross Dove from Heritage Global. Ross, Maj, take it away.
Good to see you, Ross.
Good to see you.
We just talked about a few weeks ago. Sorry to do this again to you, but we'll ask some of the same questions, some new questions. But this is really exciting.
Brand new answers today.
Good. Look, you have two parts of the business. You have the asset liquidation business, and you have your charge-off business. Which we're going to get into those things. We're going to get into the new growth catalysts going on because of the kind of new economy we're in right now. Understand some of the risks and opportunities. So why don't we just get into describing both parts of your business, and then we'll describe some of the growth catalysts in those areas. So let's go ahead.
Fair enough. So Heritage Global is in two businesses: industrial assets and financial assets. Industrial assets is actually a legacy business founded in the 1930s after the Great Depression by my grandfather, that my father was in, that my brother and I built, that my sons are in now. It's a combination of its roots in an old-fashioned auction company that now is 100% an internet-based auction company. On the industrial side, that business does two things. It does fee-based auctions for large multinational companies. Pfizer is a client with a 5-year contract. Amgen is a client. Pharma is one of our biggest sectors. We also do oil and gas for Halliburton, et cetera. So that's a fee-based business where we make a buyer's premium. That business is about half the revenue on the industrial side. The other half is a trading company. That's a trading company where we act as a principal. We'll go in if there's a failed biotech firm or a venture company's closing, or there's a 363 bankruptcy sale, or there's a factory that just says, give me the cash today. I don't want to do an auction. I just want out. We'll go in as a principal. We'll buy the assets. We'll either auction them on their location, or we'll pack and ship and move them to our warehouses and auction them for profit. Even though that's about half our sales, it's about 60% of the revenue on that side. That business also is complemented by a fee-based appraisal business who does real-world asset-based appraisals for people like Bank of America, Wells Fargo, for money center banks, and for smaller regional banks that are not interested in the enterprise value. They're interested in what this stuff is really worth if they had to pull the plug, padlock the building, give us the keys, and do an auction. So that's a fee-based business. We charge between $10,000 and $100,000 per appraisal. There's a new business on that side called American Lab Trading, which is the nation's largest stocking dealer of life science equipment. We bought them 2.5 years ago when we saw the market really moving to this ESG, ERM world, where all of a sudden putting assets into landfill is no longer acceptable. Most of my career, the big corporations didn't really care that much about selling their surplus. They weren't interested in letting it go into the hands of smaller competitors. So they scrapped a lot of stuff, and they put a lot of stuff in landfills. Now that's a big no-no. So they're forced to focus on repurposing. So we bought them because they're number one in the recycling life science business. That's been a very profitable acquisition. So that's the industrial side. Now flip it into the second business, which is financial assets. There's two businesses there. There's a brokerage and there's a lending business. The brokerage is 25 years old, and it was formed after the S&L crisis. During the S&L crisis, we had major contracts for the FDIC, for the RTC, on failed financial institutions, like you're seeing today from First Republic, like you're seeing today from Silicon Valley Bank, but it was the S&Ls. So they had massive amounts of non-performing loans. We sold billions of dollars of loans for the government. That contract ended, and me and the other founder, Dave Ludwig, said, what are we going to do with this massive database of billions of dollars in sales and all these guys that buy non-performing loans? I'd hate for it to go away. We opened up National Loan Exchange, went out to the money center banks, and we were the first person 25 years to go into the banks and say, give us your worst crap. Nobody else ever said that to the banks, ever. They all wanted the performing loans and the CMBS loans. And we said, we are the junk liquidator to the nation's money center banks. They started giving us auto loans that they never thought they could sell, that were in default, credit card loans that were almost past statute, just the worst stuff. We built a business selling charge-offs that's 25 years old that has sold $50 billion worth of charge-offs. That business slowed down 2 years ago in the pandemic, and we stayed profitable, but we weren't growing because what happened is consumers weren't spending, they were staying home, and it was consumers weren't spending. At the same time, the government stepped in with stimulus checks, so there was no supply. That's now our most rapidly growing business because consumer spending has picked up, defaults have picked up, and charge-offs have picked up, and we're looking at record profits going forward. The sister company to that is Heritage Global Capital. That was formed about 2.5 to 3 years ago. The people that buy from us started complaining. These New York hedge funds are killing us. They want 30% of the back end. They want 18% interest. It's impossible for us to pay you what we used to pay you because our cost of capital is so high. Not the public companies, but 5 through 50, the smaller buyers of the assets. So after listening to them, we said, hey, maybe we should be the guys loaning them the money because we have free cash flow. We took our free cash flow, started putting it out, and then we found some New York hedge funds so we could get a lower cost of capital than they could. To date, we funded $120 million of loans. That's a rapidly growing business. I can keep talking forever. Is that a fairly long answer to one question?
That's okay. Keep on going. So I want to understand, take me through, maybe on the special lending thing here, or on your whole financial asset division over here, a little more of a case study of how this, in the engagement. So you say that, the broker side of the business, right? You're going there and you're buying
Not buying.
Or taking the information and then putting it on the platform to be sold. So explain how that's going from beginning to end.
That wasn't your best question.
No.
All right. So in that business, it's fee-based. So we do not take title. We would never take title, and we would never buy those assets because we'd be competing with the people that buy from us. And the people that buy from us want us to be fiduciary. They want us to run open, transparent, ethical programs. So we are completely commission-based. So Santander says we have $50 million in charged-off auto deficiencies. We need to get them off our books right now, and we need to sell them in the next 60 days. We say, okay, we do an underwriting and analyze them. We come back and we say, we think they're worth a dime or $5 million or $50 million. They say, we got to get rid of them. Go ahead and sell them. So we run an auction, but only qualified buyers that are SOX 2 compliant, that we've been out to their shops and inspected, that are ethical buyers, are allowed to bid. So it's a private auction, not a public auction. Everyone can't register and bid like on the industrial side. We find the best buyer at that private auction. He pays us $5 million. We take 5% of that, a nickel. We make $250,000 on that sale. Then afterwards, if that buyer has been onboarded and it's a buyer that we're willing to lend to, he may come to us and say, I want to borrow against this $5 million acquisition. We say, okay, put up $1 million. We'll loan you $4 million. We're going to charge you 2-point monitoring fee. We're going to charge you 1 point up front. We're going to charge you 12% interest, and we're going to take 25% of the back end. And they say, okay. And then we do the monitoring and the collection over 4 or 5 years. So in theory, we're at risk as a lender. In theory, we're never at risk as a broker, and we've never had a default.
Excellent. That's perfect. So now on the, you say it's going to be the fastest growing part of your business right now, right?
The lending business is exponentially grows faster than anything else because it's cumulative. So every month you're getting paid back remittances, and every month you're taking those remittances and refreshing them and putting them out. So it's got a more steady, predictable growth that is more popular to investors in a public company than the auction trading platform, which has a lot of spikes in revenue.
Okay. But the industrial side of it is still very positive outlook now, too.
The industrial side is the hottest it's been, well, at least in the 12 years at Heritage. It's never been this hot. The reason it's so hot is there was a massive overfunding in biotech. We have 25 biotech auctions on our website today. Normally we would have 7 or 8. So the massive overfunding now with the closure of Silicon Valley Bank, with a lot of these guys that basically were venture capitalists giving them Series C, Series D, E, and F money. They finally got to F and said, no more venture money. So you're seeing many, many biotech companies closing down now. And the great thing for us, the best thing is when a company closes down that's only 2 years old or 3 years old, because we get brand spanking new, clean, great equipment. When Pfizer gives us equipment, it's 7 or 8 years old because some scientist said, I want a brand new HPLC, and he's got a tired, beat-up one that they give me at auction. When a venture firm pulls the plug, the stuff's 1 year old. So we're making a ton of money on biotech, and we're also killing them in cannabis. Every week you see another cannabis company in trouble. So I don't think everybody's maybe still smoking pot, but we're making more pot than even everybody can puff right now.
So well, now if you take your revenue right now, you've been reporting, how much is it coming from? It's still a diversified customer base here, right? In terms of your customer concentration, right? Like how much of the revenue is coming from the biotech versus other areas?
So industrial last year made more than financial, and that was pandemic driven. Right now it's kind of an equal race. So the $12 million in EBITDA last year was slightly tilted towards the industrial side. This year going forward, we announced that we're going to have a killer Q1. I'm quite happy to brag to all of you about, and the revenue was pretty much equally split.
And you said that the Q1 will be higher than your record. That was a previous Q2 record, right?
We're in the business of breaking records this year.
Right. So now there's other. Now you talked about the biotech situation, but there's a lot of things going on too that outside biotech that are good for you too. I mean, there's Chapter 11 bankruptcies that are happening now.
There's an increase. What happens is when inflation rises, it's very simple, and that interest rates then get risen in order to cure inflation.
Right.
When you rise interest rates, it's an empirical truth that it creates corporate defaults. So as interest rates go up, corporate defaults go up. As corporate defaults go up, surplus assets increase. So we're in a situation right now where you don't have to be an economist to see there's going to be more auctions over the next 2 years than there have been over the last 2 years, because there's no way you can curb inflation without some rise in interest rates. There's no way you can have some rise in interest rates that don't increase corporate defaults. But that's coupled with kind of this new mentality right now that layoffs are now popular. Everyone in technology is doing layoffs. Layoffs create surplus assets to auction. So all these layoffs you're seeing now are not auctions now. They announced laying off 3,000 people. It takes 3, 4, 5, 6 months to effectuate the layoffs. Then after the layoffs are effectuated, then it trickles down into the back end of the supply chain where the surplus people finally get a handle around the excess assets and use people like us. So that's why we're bullish on the second half of the year. And everything you read, if you look at the National Association of Manufacturers, the buzzwords now are all about right sizing, all about lean management. That also creates surplus assets. And on the switch side to that, more and more of them are using outside people. They used to sell it on their own a lot, but this whole new push to where business process outsourcing is like a goal in all these companies. We're lowering headcount we're going to use more outside people to do, things like asset sales. So asset sales doesn't really belong in the corporation. We can do it for them, better than them at reasonable prices.
Now, you've been doing this for a long time. So if you go back in your history, and can you compare this period to another period that is comparable? Is it better, maybe potentially? I mean, is each one different?
Well, back in the 1800s, when we took the stagecoach to the auctions, the world changed for auctioneers in 1999. So the first invention for auctioneers was this, what I'm holding, a microphone. So you could sell to the guys in the back of the room. That lasted most of my life. I flew around the world with this microphone, $5, could have been 10, could have been 15, doing that every day on a ladder. And then in 1999, I woke up and they disintermediated me and everyone like me with this thing called the internet. So for 2 years, we said we can beat the internet with the microphone. So for 2 years, I kept calling bids and saying, I can get more money than that computer. Over and over, the empirical data showed that I was out of my mind and that you could not possibly get more money calling bids in a factory than you can get with the internet, where you opened up the bidding to the entire world. So we switched to a complete e-commerce internet company. So when you say what changed, that was the major one single change that was most dramatic in my lifetime. What's happened over the 40-something years I'm doing this is the assets change. So there was a period for 2 years where all I sold was textile assets. And then I woke up one day, there was no Levi Strauss manufacturing in America, no lead manufacturing. Textile left the country, and I was out of that business. There was a 5-year period where all we did was semiconductor auctions for everybody, from Intel to AMD. And then semiconductor moved to Taiwan, moved to Korea, moved to Japan, and there were no more semiconductor auctions. So you get these runs. Right now I'm on a biotech run. We had many years of a solar run. In the year 2000, we did 250 .com auctions because all at once the venture world gave up on .com. So it's all these cyclical auctions where you get these 2 and 3 year runs, and then sometimes you get this really tough static economy where there's not enough supply. But so if you're going to buy heritage, what you want to figure out is when there's going to be 2 or 3 years of increased supply, because increased supply, it was what drives our revenue. So right now, the change is there's increased supply on both sides. Mm-hmm. There's the increased consumer spending with the layoffs and the increased industrial assets.
Excellent.
So you should invest today, Maj.
Well, I already am.
All right.
So, I want to share a stat with you from earlier. Another company that actually, earlier, Credit Responder, they actually help businesses manage risk with their vendors and stuff. And one of the stats I brought up then was, we do, as you invest, we run a stat every quarter when earnings come out. And there's still, last quarter, Q4, there was 1,300 around that number of companies losing $20 million a quarter still. It's pretty amazing.
Wow, that's a lot of them.
That's a lot.
Give me that list.
A lot of opportunity.
Give me that list and I'll start cold calling.
So that brings me to the next thing. And so, okay, this is a great opportunity. But when we look at the competitive framework, I mean, you're not the only one doing this. So does everyone have access to the same data? What makes you so better than anybody else doing this? I mean,
well, we're definitely the best looking company in the industry.
You got that.
So that helps a lot. I mean, when they see us, the other guys go running.
Right.
So the sweet spot is you're really good in a sector. So if the sector right now is printing, we're not the world's best printing auctioneer. There are experts there that would know printing more than me. So every auctioneer's got some specialties. And if it's technology based, if it's pharmaceutical based, we're kind of number one in the industry. If it's old school woodworking, there's other guys that are better. We're very good at aerospace. So there's a lot of aerospace now. If it's automotive, there's a couple guys in Detroit that may beat us. So it really depends on the industry. It's primarily legacy family businesses, the top 50 auctioneers. There's a Liquidity Services is a public company. B. Riley is a public company that has an auction division, but it's mostly family businesses. And ironically, They're our competitor one day and our partner the next.
Okay, interesting. How you attack in the tech industry? How was your especially there? I mean, you were doing that before, obviously. So
we were the original tech auctioneer in 1984. We sold the personal computer manufacturer, Osborne Computer. And all of a sudden, my father and I had no clue what we were doing. They actually said, "Are you going to sell the chips in the back of the factory?" My father didn't know they were semiconductors. He said, "They have woodworking equipment here?" So we literally accidentally had a phenomenal world record auction, not even knowing that 100 other personal computer companies were going to close. So that was the beginning of us becoming a technology auctioneer. After all the personal computer companies closed, then all the disk drive companies closed. So then all of a sudden there was just two or three. There was just a Dell and a Compaq, and there was just a Seagate. And so we did a couple of hundred technology auctions. And by the end, we called ourselves a technology auctioneer.
Now, speaking of the competitive landscape, I mean, you said there's a lot of these mom and pops out there doing this. What about acquisition opportunities for you? Some more you've made acquisitions. What would that look like for you moving forward here?
Well, one thing I learned in my prior company is when you buy a mom and pop company and the son wants to stay and dad wants to retire, it can work. But if you buy the wrong mom and pop companies, everyone joins a country club the day afterwards and they get unbelievably good at their handicap with all the pressure off of them from working. So it's not easy to roll up family-style businesses where the soul of the machine is the family. So ALT was a different story because they had an inventory and it was more technology-driven and they had some intellectual capital. But just the tangible physical auctioneers, their heart and soul's in their family business and their grandsons running it, I think I'd mess them up more than help them.
Okay. So from what you see out there now with the assets, the supply coming out, what kind of runway do you think you have? I mean, is it from your experience, from what you see out there right now of opportunity?
When you're 70, you don't worry so much about the runway when you're 30. So I think we got plenty of runway and room for my sons and my brother's sons to do it. I think the next 2 years are going to be a fantastic time, not just for Heritage, but for anybody that is selling distressed assets that's a liquidator, period. I think there's going to be a lot of distressed assets and a lot of asset flow. So I think the next 2 years is going to be a good time to be a liquidator, whether you're a fintech company selling troubled loans or you're an industrial auctioneer. I mean, if you just look at it, pretty much every sector is going to be busy.
And you did almost $50 million in revenue in 22. You put up some nice EPS of 23 cents. So you're a microcap, but you have some real revenue here, which is nice and unusual sometimes.
We went from a mini microcap to a regular microcap somehow.
Yeah. So I had a question, and we talked about this before. There seems to be a seller out there, right, in your stock, and we're hoping that you can shed some light on that.
The former chairman's in his 70s. He's no longer the chairman of the company. He's right-sizing, and I don't blame him at all. He's been right-sizing his estate in his mid-70s, and he no longer is getting paid by us. He's no longer on the board of directors. So it's a timing issue with him. One of our largest shareholders, I don't see if he's in the room here, I won't point him out. One of our largest shareholders who bought stock at 30 cents and 35 and 40 cents and listened to me the first time I gave these speeches is taking some profits now. So there's been 2 shareholders basically, in my opinion, putting some downward pressure on the stock. If they keep selling, my intention is to punch them out.
I thought you were going to say buy them out.
Yeah.
And one last thing, any operating leverage in the business? Let's end on that.
The greatest operating leverage in this business is that it's 100% an e-commerce business where in the end of the day, I can sell 3 or 4 times as many assets as I have today, as long as I can garner the supply without a big increase in OPEX. Very few people can say I can double or triple my top line and my net income with hardly increasing any OPEX. So there's more operating leverage here than in almost any company. And I'll end it with my pitch. Go find a company that's going to look you in the eye and say, I'm going to make $12.5 to $15 million this year that has $100 million only microcap. If you can find another company that can say that, you should buy both of us.
I'll be screening tonight.
All right.
I told you that. Well, thanks, Ross. Awesome.
Thank you, Raj.
Yeah, great job. Thank you.